So let's begin. Hello everyone and welcome to today's webinar event. I'm Terry Ryder, founder of hotspotting.com.au, and my special guest today is Australia's foremost expert on depreciation for property investors, Peter Folds of Washington Brown. Today we're going to be talking about residential property investment from a variety of perspectives. We're rapidly approaching the end of the financial year, and it'll be understandable, I suppose, if many people didn't have that strongly in focus right now because there have been one or two distractions of late. But it's the time of year when switched-on investors will be thinking about tax time and the very important part that depreciation can play in improving the bottom line for property investors. A key factor is that there have been changes impacting depreciation, but given the magnitude of the health and economic issues dominating news media, they've not received a great deal of coverage. And as we approach the end of financial year and tax time, it's critical to know about key factors like tax depreciation because it can put thousands of dollars into the pockets of everyday property investors. Today we're also going to be discussing some of the broader property market issues, such as what investors can expect to happen to prices and what we expect to happen in different locations as we start to see the easing of social restrictions and getting back to some level of normality. And as we work our way through these important issues today, we'd like your involvement. So please give us your questions and comments, which you can do by typing into the chat box that you should see in front of you. And if you'd like to have a live chat with Peter and myself, you can do that by clicking on the put your hand up button, which you'll find in the chat box, and we can unmute you, and then you can ask your questions live and we can have a discussion. So let's meet our special guest today, Australia's leading expert on depreciation, Peter Folds of Washington Brown. So Peter, welcome.
Thank you very much, Terry. Always a pleasure to have a chat with you. I know you're very busy and in demand, so thanks for making time to catch up today.
Always a pleasure. I love talking about all aspects of property investment, and I think we're going to have a more general chat first and then get on to the more specialised topic of depreciation. But I do like having that specialist discussion because I know how important it is, and also how to the degree to which many investors overlook it or neglect
Absolutely.
it.
Terry, you're absolutely right. It's in a normal year, this is something that depreciation is something that often gets overlooked. This is whether that's because people are understandably busy or they don't know about depreciation benefits. It does get overlooked. But as you mentioned before, particularly now, we've all had some rather large distractions or more important or concerning things to keep in mind. I suspect that it'll be even more sort of overlooked for a lot of investors, which is a shame because particularly at times where a lot of Australians are doing it tough in terms of income, depreciation really can make a huge difference to an investor's cash flow. So potentially more important during these times or now than ever. But Terry, before we jump into that, I did have some questions for you, if that's all right. Terry, with the media coverage we're getting now, at the best of times, there's always a lot of doom and gloom because it sells news. I guess to cut them some slack, there has been a lot to be somewhat gloomy about over the last few months. In terms of property, though, we're sort of being told, or the general feel from the media that I've gotten is that pricing's taken a hit, or that the Australian property market has taken a hit over the pandemic time. And I wanted to ask you a bit more about that. Do you think that's accurate? Is that the case?
Well, no, it's not. I mean, all the data that's coming in actually defies those sorts of notions. Certain sections of media in particular have been talking down real estate or telling us to expect a major decline. We just haven't seen it in terms of pricing. There's been some quite remarkable statistics that's come out, including today, Peter, the latest figures in a report from realestate.com.au, which most people interested in property investment will be familiar with as the biggest site that people go to looking for properties to buy. And their figures show that there's been a very significant increase in the number of searches. In New South Wales, there's been a 39% increase in people searching for property on their website compared to the same time last year. In Victoria, it's up 40%. Also in South Australia, it's up 40%. Queensland up 33%. So people are certainly out there looking. And that might explain why the data on prices for April was so strong. 6 of the 8 capital cities recorded some level of increase during April, and 6 of the 7 regional jurisdictions also increased and achieved some level of increase in property prices in April. And I thought that was remarkable. A month ago, when the figures for March came out, the March figures were very positive across the board as well. And media's attitude was, well, yeah, but it's too soon for the virus impact to take effect. Wait until this time next month, the beginning of May, and we'll start to see a big decline.
Mm-hmm.
But we didn't. We haven't. So now they're telling us, wait another month and we'll see a big decline. Real estate is continuing to defy those doomsday predictions. And I think it's going to keep on doing that. It's very, very solid. It's the nature of real estate to a large degree, and the hold that it has in the psyche of Australians, both for homes and also for investment. So to date, it's done pretty well. Not everywhere has done well, of course. And probably it has to be said that the one area where we have seen evidence of decline is in rentals. That's the part of the market that seems to be taking a hit.
Yeah, right. That is very interesting, Terry, and makes a lot of sense, I guess, as well, particularly about, I wouldn't have thought of it at first, but the searches or the search figures showing such a significant increase. I guess it shows a lot of course, a lot of interest, but a lot of confidence in the market. People have also got a lot more time if they're stuck at home. So you'd see the amount of time they're putting into researching and investigating go up. So that makes sense too. Terry, with this notion of there being one property market that we can make general speculations over, I know you've got particular feelings on that notion being conveyed by media. Are there any particular markets or areas that have done well, that have grown, or that are showing growth within this pandemic period or despite this pandemic time?
Yeah, I mean, you're right. I do get frustrated when media generalises about Australia as a single market, and economists tend to do that as well. And they feed that into media. They talk about what's going to happen with Australian property prices as if it's just one big market. And of course, we have so many differences, thousands of different markets really. And we're probably going to see that through this period more so than in normal times as well, because the nature of the local economy is going to be very pivotal in terms of which markets are going to do well, which ones are going to stagnate, and which ones are perhaps going to fall a bit. For example, I would expect a market like the Gold Coast to take a bigger hit than most because its economy is so heavily reliant on tourism, with a big component of international tourism, and that has taken such a big hit. So my expectation would be that the Gold Coast market will be one of those that will drop, certainly in the short term. Whereas others with a different economic makeup, I would expect to do quite well. We have seen that certain sections of the economy have not only done okay, they've actually thrived in this climate. Supermarkets have been doing a booming trade, bottle stores, pharmacies, and the people who supply to those sorts of businesses are doing pretty well. Technology businesses is another one that's going well. So we're very interested in the makeup of economy. We find that there are certain regional cities of substance which we think are going to ride this out pretty well and be very well placed to surge once we get back to some level of normality. And I think of regional centres like Ballarat and Bendigo in Victoria, Orange in New South Wales, Sunshine Coast and Mackay in Queensland, and many others, Albury-Wodonga at the border between New South Wales and Victoria. Very strong regional cities with diverse economies, certain element of tourism for most of them, but very, very strong areas that are good to be strong in at the moment. I actually did a broadcast earlier this week with some real estate professionals in Albury-Wodonga, and we looked at the industry sectors that provide the greatest number of jobs in that city. And there are all areas that you would expect to thrive. Supermarkets and food stores, for example, was a very big employer there. Medical services was a very big employer there. Education services also. The military is also quite a big employer. There's a presence of a big army presence in that a regional city. So they're all areas where employment has stayed really strong. In fact, in many cases, employment has increased. So a regional centre like that is very, very well placed to do well in this downturn and to come out the other side very strongly. So those are the sorts of places that I think investors should be keeping an eye on. Plus the fact that they're very affordable compared to the big cities and have much better rental yields. And in the case of Albury-Wodonga and others, very low vacancies at the moment. So, yeah, really good places to consider right now in the middle of all this.
That's very interesting, Terry. Thank you for that. And I guess it's also good to consider that, yes, during this time, affected by the virus, certain industries are going to be heavily affected. We see that every day. So naturally, an area that's reliant on tourism, yeah, absolutely a massive hit. But I mean, and correct me if I'm wrong, but I think areas like, the Sunshine Coast, where the drivers for, that might be attracting property investors are to do with, massive infrastructure projects. Yeah. Construction hasn't stopped during this time. It was considered essential. So the bonuses or the ticks in the pro column why you would be looking at potentially at investing in a region like that haven't gone away during this time. They've continued as normal. Those things are still attractive, right?
That's very true. I mean, say 6 years ago, the Sunshine Coast as it existed then would have taken a hit because it was fundamentally a sleepy tourism town. But so much has changed there, and right now there's this huge infrastructure spend happening, the new medical precinct, the new CBD, the upgrade of the airport to going international, the subsea cable with internet links to Asia, and a whole lot more, and all that's ongoing right now. So the Sunshine Coast is holding up extremely well as an economy, and speaking to local valuers who are active every day in the Sunshine Coast market, I've seen no evidence of a decline in values at all. In that market. So, you really do have to look at street level at the makeup of locations. It's not certainly the case that there's going to be one situation across the country. It's a case-by-case situation, and there's some very, very strong and vibrant economies and therefore real estate markets out there at the moment.
Yeah, great. I did want to ask that because I think it's truly important to keep a balance, particularly in times like this where it's very, very easy to get swept up, as I mentioned, in the doom and gloom, that it doesn't apply to everything all of the time. That's fantastic to see that balance to that, Terry. Thank you. Look, you're by nature of what you do, Terry, you're a man of specifics. So forgive me for asking you to generalize here, but with many markets around Australia then showing positivity or continued growth, with interest rates the lowest we've seen them in such a long time, is it a good time to be thinking about purchasing property or investing?
I think it's a very good time. I think it's a very good time to be looking because there will be opportunities to buy well. Generally speaking, real estate's holding up quite well, but there will be exceptions. There are way too many people who have lost their jobs, or their businesses have been forced to shut down, or their businesses have been contracted by the current situation. And so there will be opportunities perhaps to buy real estate at good prices. As you pointed out, interest rates are very low. And if you're out there as a buyer right now, you're not going to be competing with as many competing investors as you might have done in normal times. So you can perhaps negotiate from a position of strength. And of course, it depends on which market you're delving into. But I think it's a very good time to buy. A lot of people have taken the attitude, we'll sit back and wait and we expect prices to fall, and when it hits the bottom, we'll jump in. I really don't think that's going to happen to any great degree. And I think people who just sit back and wait, by the time they read in the paper that there's prices are rising again, they will have missed the best opportunities to buy at the best prices. So I think people should be busy having a look now. And the searches that the figures from realestate.com.au suggest that a lot of people are actually doing that right now.
Well, yeah, and another interesting point, Terry, I skimmed over some data this morning that was already suggesting that whatever drop in pricing that was conceived or hypothesized has already sort of started to climb back again, that it's already increasing. So yeah, that notion of sitting down, biding time and waiting for things to bottom out again doesn't look like that's going to happen either. So yeah, quite right.
I think it's very important to, when you're, I think people have a tendency to digest sound bites and headlines, and you've got to be very careful about where you get your information and what the source of that information is. I think the seasoned specialist, experienced real estate analysts are the ones you should be listening to. There are some the usual suspects out there that are always talking down the real estate market, always predicting a collapse in property values, even beyond this pandemic period. The usual suspects are always doing that, and you just need to be mindful of who they are and to not listen to those kinds of forecasts, and get your information from the seasoned specialists who really do understand how real estate works.
Yeah, right. Like invaluable information. It's I think easy to get swept up in it, as I said before. So yeah, good to keep a balance and to I guess just place a little weight on the source or the motives from where that information is coming from. So that's very valuable.
So Laura, who's out there watching and listening, Peter, says, "Hey, I thought this was supposed to be about tax stuff." And well, you're right, Laura, it is. But we also wanted to just sort of set the background to where things are with the real estate market, because it's so relevant to this discussion. It sets the background for concentrating on some of the tin tax of real estate investment, which includes the very important issue of depreciation. So perhaps we could turn our attention to that, Peter. And
yeah, sure. What a fantastic segue. So thank you, Laura, for that, and to everyone out there for joining us today. So it is a particularly important time of year to start thinking about tax depreciation, if you haven't done so already. And Terry, I thought, yes, there's parts of tax depreciation that are particularly relevant to this pandemic, but I thought I might just cover a bit of an overview on what depreciation is, in case there are investors out there that aren't aware of depreciation or how it works or what the benefits are. So I might have an attempt at sharing my screen. If that's going to work. So if we look at what is tax depreciation, because it's not something we learn at school. We're not taught about this in high school. At least I certainly wasn't. So it's nice to go over the basics. So what is property tax depreciation? And when we talk about a depreciation report, what are we talking about? Well, property tax depreciation is a legal tax deduction related to the wear and tear of an investment property over time. And I like telling people when asked or when they'll give me the opportunity, it's similar to a plumber. If she or he buys a brand new ute to carry tools and to attend site, that ute is being used to generate a taxable income. And the government allows a tax depreciation deduction on that vehicle. As it gets older, the wear and tear in that vehicle can be claimed as a tax deduction. We're still very lucky in Australia that to be able to have the same benefits on an investment property. Because that property is being used for income generating purposes and that income is being taxed, government will let us claim the wear and tear as a deduction on our taxable income. So that's what property depreciation is. We often get asked whether it's the same thing as a valuation, and it's not. A valuer is looking at many market factors, supply and demand considerations. In accordance with ATO guidelines, tax depreciation is specific to the construction cost, the original construction cost. As quantity surveyors, so that's the science or the profession behind tax depreciation. We're recognised as having the experience and skills required to prepare a tax depreciation report, and that's an ATO compliant document that details all of the depreciation deductions that you as an investment property owner are entitled to claim each year for the maximum allowable duration, which is 40 years. Why should you care about all of that if you're an investor? Well, the summation of it all is that claiming depreciation reduces your taxable income, which means you pay less tax. And as we were saying with the current climate and a lot of Australians doing it a bit tougher at the moment, paying less tax, I would have thought is more important than ever. And we can look at, I can give you some more examples in a few minutes of exactly how that looks, claiming depreciation, and what that can mean to a cash flow. So just continuing on the what depreciation is, there are two components that we're assessing when we look at a property's tax depreciation. It's the plant and equipment component, so the items within, things like carpets, blinds, ovens, air conditioning units. The second component we're looking at is the building allowance, or the structure itself, and that's things like the bricks, the windows, the concrete, so the actual building itself. And just finally on this overview topic, there are two methods of calculating and claiming tax depreciation. A report from an accredited quantity surveying firm, like such as Washington Brown, obviously, will contain both methods as standard. So it's not something you need to know before getting a report. Our depreciation schedules will include both methods of calculating and claiming depreciation. You can see, a simplification of it is the two methods. The diminishing value method weights the bulk of deductions in the earlier years, and then it exponentially decreases. So this is giving you the maximum deductions in the earlier years, if you're eligible for this one. And the prime cost method, as you can see, very simply evens it out. In fact, it's often called the straight line method of claiming. Gives you a sort of a stable, predictable, constant amount of deduction each year that you're eligible to claim. So that's the what is tax depreciation component. I mentioned that we at this time of year become very, very busy, and it's because a lot of investors either don't know about depreciation or have pushed it off. It's important coming up to the end of financial year and before lodging your tax that you're inquiring about a tax depreciation schedule for your investment property if you don't already have one. You want to make sure that report is completed and ready by the time you lodge your tax, so that you're ensuring you're not missing out on any depreciation deductions.
Okay, so Peter, I've seen examples that you've shown in the past where someone might have a property investment where the net result is that it's a certain amount of money coming out of their pocket every week or every month because it's negatively geared. But once you apply the tax depreciation benefits, it can turn around and turn into a cash flow positive property. That's one of the ideal outcomes that
Sure.
people should be aware of.
And particularly, Terry, with interest rates as low as they are now, that's a more likely scenario. Jump in and share my screen again. I can walk you through another example of that. So I just show this one here. So mentioning about those deductions and how it actually plays out. To put some context around it, this example, if I'm not claiming depreciation, if I've earned $90,000, I'm taxed at 32.5%. This is the amount of tax I pay. Now, obviously, this is a very simplified example, but important to compare that to that same scenario, so same earnings, same tax bracket, but my depreciation schedule shows me that I'm able to claim $4,000 in tax depreciation deductions in a particular financial year. You can see how that affects it. Instead of being taxed on that $90,000 income, as we were up here, we can reduce that taxable income by the $4,000 worth of depreciation deductions. It means then we're only paying $27,950 in tax. Now, once we look at the difference between that, we can see a pretty clear benefit. So by claiming that $4,000 in tax deductions in that financial year, it actually equated to a saving of $1,300. Now, that is a significant boost to anyone's cash flow per year, and certainly not something you want to be donating to the tax department unnecessarily. Was it Kerry Packard that said, pay your taxes, but don't tip them? If we go through some examples, I think, Terry, I've put together two examples, and these are particularly pertinent, and I'm sort of a little excited and worked up about these two because they are actual real results that we've done achieve for two particular clients recently. Both of these clients, the reason why I picked these examples, both of these clients had been told by various people or influencers in their property journey and finance journey, that because the properties they were purchasing were not brand new, that it was not worth getting a tax depreciation deduction. So I thought it might be interesting to show, two scenarios where literally these people would have missed out on $1,000 of deductions because of misinformation that they were fed. So I'll just quickly show you those. The first one is a property in Bayswater, Victoria. This was a 4-bedroom house. Now, this was built in 1970, so no spring chicken on that front. You can see here, purchase price is $740. The settlement date was earlier this year. Now, as we would expect with an older property, it's probably had some work done. Now, in this case, the new owner, so the one that purchased in January, had added, new carpets. They needed to be upgraded to get it into a rentable condition. They bought a dishwasher and a small split system air conditioner. So not a huge expenditure. But as accredited quantity surveyors, we were able to also accurately assess the cost and dates involved with previous owners' improvements. Now, the ATO understands and does not expect the new owner, the current owner, to have any information about any previous owner's works at all. That's why you would engage a quantity surveying firm. That's our job. And in this case, it was very, very obvious to see that, I think from memory, it was roughly about 5 years before this purchase. It looked like both bathrooms had been upgraded. The kitchen had undergone a renovation, and they built a small aluminium awning over the patio. So for this property that they were told was old and therefore not worth getting a depreciation report for, we're actually able to achieve the first full-year deductions of $2,000 of tax deduction. So in that year, the taxable income was reduced by $2,000. Over 10 years of the report, was actually $15,000 worth of deductions, Terry. So you can see how for a very small outlay for the report, despite this being an older property, still very, very much worthwhile.
And Peter, there's a question that's just come through, which is very well timed because it very much relates to that example you're giving. And the viewer is saying a few months ago, I bought an investment property in Melbourne, built around 40 years ago. The previous owner must have spent 60 or 70 grand to fully renovate the property before I bought it. Will I be able to claim depreciation? I think that's one of the key questions that people would have.
A fantastic question, and amazing timing with that. So this is another misconception in the market. There's a lot of sort of misinformation circulating about that. Once again, that the property is old, therefore no deductions available. this is relating to this notion comes from legislation changes that were announced at 7:30 p.m. on Tuesday, May 9th of 2017. And essentially the government has said that if an investor purchases a property, an investment property after that date, a second-hand investment property, I should say, they are no longer entitled to claim deductions on the plants and equipment. Now, you remember in my earlier slide just now, I was showing you that there are two components to depreciation that we're looking at. So yes, it's true. On a second-hand property, you are not eligible to claim deductions on the plant and equipment component. You are still very much entitled to claim deductions on that structural component. So to bring this back to the question that was asked, in summary, yes, there are absolutely deductions that you as the current owner or new owner are entitled to claim because of the previous owner's renovations. You are not, if I look at a kitchen, so if as part of that $60,000 or $70,000 renovation that you suspect they've done, they've renovated the kitchen. Now, you as the new can conduct the range, the cooktop as part of that kitchen renovation. That's considered plant and equipment. And as I said, as of that legislation change in 2017, you're not eligible to claim deductions on that. However, you are still very much able to claim deductions on the structural component of that kitchen. So the cabinetry, the tiling, the ceiling work, any splashbacks. So it is very important to remember that you are able to claim on the structural component of any previous owner's renovations. Definitely worth asking the question if you've purchased an older property. If we look at the second example that I prepared, it also touches on that question that was just asked too. So this property was built in 1994. So the one before was 1970, this one 94. This is in Castaways Beach, so just outside of New Zealand on the Sunshine Coast. This one was purchased for $900,000 in July of last year. Because of the state of the property, there were no new additions required. But once again, in doing the report, we ascertained that there'd been the bathrooms renovated with laundry as well, a kitchen, some retaining wall and paving work in the garden, and the place had been painted recently before purchase. And in this example, we were able to achieve $3,500 in the first full year and $35,000 over 10 years, which are huge deductions. And once again, this client was also told that because they were purchasing an older property, that it wasn't worth getting a depreciation report. So interesting to consider.
So, Peter, we've often had the discussion about the return on investment when you spend a relatively small amount of money to commission a depreciation report from Washington Brown, and in relative to the return on the investment. Again, I think that last example illustrated that quite well, because if I understand it correctly, you spend some money once to get your depreciation report, and you can use it over that 10-year period in which you got those $35,000 worth of deductions.
Yeah, correct. In that particular example, those deductions actually lasted for another 15 years on top of that. But yeah, you're quite right. So there's the initial fully tax deductible cost of a depreciation report. Pardon me. It's a one-off expense, or at least if you've gone with an accredited, reputable quantity surveying firm, that expense is a one-off. That report lasts you, it outlines all of the deductions you're entitled to claim for the complete duration of your ownership of that property. So once again, a one-off expense, a fully tax deductible expense. The only reason you'd ever need to look at having that report redone or amended is if you make a renovation sometime in the future. You need to update that report to include the items as part of that renovation. So yeah, it's probably one of the only expenses in the property investment journey where you see such a I guess, a tangible and immediate return on that expenditure, Terry.
Yeah. And again, very timely, Rena is asking the very simple question of what a typical report does cost relative to the benefits that you've just illustrated, particularly with that most recent example.
Yeah, sure. Okay, so a typical report is anywhere from 660, including GST, up to 770, including GST. I think in the lead up to the end of financial year, and certainly anyone mentioning hotspotting.com or this session, Terry, would be looking at 660. That includes an inspection where necessary on a residential property anywhere in a metropolitan area around Australia or in major population centres. Important to mention now that an inspection is not always necessary. Certainly with Washington Brown, we're one of the most experienced and long-standing firms in our industry. So with over 40 years experience, Terry, we're familiar with the vast majority of residential and commercial buildings around Australia. So we've amassed a database of construction costs of a huge number of properties and developments, and ever growing around Australia. Where we've got access to that information, often conducting an inspection doesn't add any benefit or value to the client. So we'll always assess that, conduct a pre-qualification, if you will, to assess whether that inspection is necessary and whether it'll add value for the client. If we feel that we have enough information to be able to prepare that fully comprehensive ATO compliant report without the inspection, that's going to bring the price of the report down too.
Yeah. Now, with all that vast experience that you have in preparing these reports and dealing with property investors, it's still the case that many investors don't get depreciation reports. In your experience, what are the factors that hold people back from taking that simple step? What stops them doing it when the benefits are so tangible?
I would say, if I can be cheeky and sort of put two reasons or two suggestions forth on that. One, I think, is just lack of awareness of depreciation. It's simply a case of people don't know that they have the ability to claim these tax deductions when they purchase or own an investment property. So I think that's a huge one. Just lack of awareness and education regarding tax depreciation is a huge one. I think the second one might be, certainly in my experience from speaking with clients, is the misconception that it's not worthwhile. And I mean, at Washington Brown, we're very, very nerdy regarding the topic, and very passionate about education. So I would urge anyone to let that decision of whether it's worthwhile or not rest with experts in that industry. It costs nothing to ask the question. We very much encourage investors to get in contact with us or me, give me a little bit of basic information regarding the investment property, and ask, look, what would I be looking at in depreciation? What are the likely deductions available to me? And then you make your decision whether proceeding with a report is worthwhile from there. So yeah, those are the two reasons, Terry. I think people either don't know about it, or they've just assumed or been told that it's not worthwhile doing. They should definitely ask the question. Avoid missing out on potential deductions, particularly when it costs nothing to ask.
Do you think some people are put off by they think that if they go down this path, there's going to be a lot of extra work involved, when the reality is that Washington Brown pretty much does all the work for them? There's not a lot that people have to do other than make the phone call.
I wish I knew of an industry where there was a commodity or a product being sold where someone could charge someone money, have them do all the work, and then still collect the cash on the other end of that. Certainly not the case with quantity surveying or depreciation. Yeah, potentially people might think that there's a lot of work involved. When we're preparing a report, when someone accepts a quotation from us and engages us to produce that report, The only homework that they've got is providing a little bit of property information. So that's always going to be obviously the address, the ownership entity name as per contract of sale. I'm going to want the details of any additions that you as the current owner have made to that property. And that's really it. If we're inspecting, I might need your property manager's details. If you've got documents handy that are pertinent to the property, that's beneficial. It's as easy as that. Most people have got that on hand, and most of that information is contained within the contract of sale or readily available. So not much work on the client side at all.
Okay. And Malay's asking the question here, which relates to, I think the point that they're making is that you can get tax benefits by using depreciation, but the Australian Taxation Office sometimes finds a way to claw some of it back in the life cycle of owning a property.
Yeah, and I mean, that's true in part, but important to clarify, they don't claw it back during the lifetime of the ownership of the property. It's true that you that property, what you've claimed on the structural component in deductions or depreciation does factor into your capital gains equation. So in that scenario, you would have to factor in or account for the depreciation you've claimed on the structural component. But in Australia, where we're still enjoying a 50% allowance or a 50% reduction on our capital gains tax amount. So even the amount that you do have to factor back into that equation is at a reduced amount compared to what you've claimed it at. You're still better off with that money in your pocket, increasing your cash flow as you go, and potentially only having to factor in half of that if you do go on to sell the property in the future.
Okay, and there's a question here about somebody who's buying 50% of a property. I guess that might be a joint ownership situation. It's been owned for 12 years. Can I still get depreciation for my 50%? Do you come across those sorts of situations with what you do?
Yeah, we do. There are a number of reasons why that scenario occurs, and some of those are on the increase in Australia. But yes, absolutely possible, very much so. So I've even seen scenarios where that might look like thirds or quarters in a property, and it can certainly be done. It's actually quite common, and no issue at all in preparing a depreciation report for you that only or is a portion to the 50% of that property that you own.
Okay. Just a reminder to people, if you'd like to have a live chat and ask your question live to myself or to Peter, you can do so by using the chat box to put your hand up by clicking on that in the chat box, and we can have a live discussion here today. Now, Peter this is another Peter asking, Peter, it's fair to say that new plant and equipment can be depreciated, being distinct from plant equipment included when the second-hand property was purchased. I think I know what that means.
Yeah, fantastic question, and great segue to one of the points that I absolutely needed to make mention of, is that if you are purchasing a brand new property, you are still very much entitled to claim on both components that I mentioned at the start of today's session. So both the plant and equipment and the structure as well. Now, in a brand new property, the plant and equipment are seen by the ATO as not previously used. So that's the buzz phrase is previously used. So because they are not previously used, and you are the first owner, you are absolutely able to claim depreciation deductions on those, and that is going to boost the depreciation figures, particularly in the first 5 to 10 years, dramatically, with the inclusion of those plant and equipment items. Absolutely. I might actually jump to a cash flow table that I prepared earlier, which sort of looks at new property and depreciation on a new property versus second hand. So if you're all seeing that here, now there's a lot of figures on this table, but if we pick, if I show you the brand new property column, this is a simplified cash flow scenario of how claiming depreciation on a particular type of investment property benefits the bottom dollar in terms of weekly cash flow. So you can see here, if we assume a $600 rental income per week, this is for a brand new property. Interest at 2.9%, which is very, very achievable in the finance market at the moment now. So if we look at taking our rental income, minusing the interest we're paying on that loan, the other expenses, so the running costs essentially of owning that property, we're left with it says outlay here, but in this scenario, we're actually left with a surplus of money after these expenses have been deducted. Now, with a brand new property versus a property, second-hand property, you can see here, we're still claiming deductions, depreciation on the structural component. But like Peter asked in that last question, Terry, here we're now able to claim on a brand new property, depreciation on the plant and equipment, the brand new, not previously owned plant and equipment component. So you can see what a huge increase that is in deductions there versus a second-hand property or a pre-87 built property. If we look at run the figures and move down here, we're taking, if you look at the surplus we had, minusing the depreciation benefits, you're looking at, in these two columns here, the total taxation loss. Assuming a 37% rate of tax on that taxation loss, we've actually received a refund of this amount in these two scenarios. So for a new property, we've been refunded this amount. We've got the surplus from the rental income here, less expenses, which equals just over $7,000 that we're up. And if you look at a modification, a tax modification form, being able to claim that monthly and then weekly, this is actually cash flow positive. The property is putting $137 back in your account after tax. Now you can see that when we're only able to claim deductions on the building component and not the plant and equipment, it's still positive, much less, but still positively geared in this scenario. So, yeah, I mean, the table can look complicated at face value, but hopefully that sort of highlights the real impact of the context of claiming depreciation on a second-hand property or a brand new one, how it really affects the cash flow position for an investor.
Okay, so people sitting out there wondering what they should do and how they should do it. What's the easiest way to proceed? If they're unsure, who can they ask and how can they go about doing that?
I would urge everyone listening that has any questions to contact me directly via email. They can reach me at info@washingtonbrown.com.au, and we can send those details out via email afterwards. Very happy to provide quotation, but also to give any estimates, to provide the sort of an idea of the likely deductions, if any, on your investment property. As I said, that costs nothing. So yeah, feel free to reach out via email. Can't be easier than shooting me an email and saying, hi Peter, can I claim deductions on my investment property? And if so, what would they look like? Be very, very happy to help.
So, Peter, has anything changed recently? I know that there were big changes in 2017, but while we've all been distracted by some fairly major global and local issues, is anything changed that people need to know about?
Industry-wise and legislation-wise, not particularly, But in relation to this pandemic, and I was sort of hesitant to speak too much about the impact of the pandemic, because already since we started advertising and planning today's session, Terry, things have changed dramatically, and I expect we'll have again in another 3 days or so. From our business's perspective, the focus has always been on helping Australian property investors. I know that sounds very benevolent of us, but maximising deductions and helping property investors to improve their cash flow has always been at the core focus of what we do. So in relation to the pandemic, once again, because a lot of people have had incomes affected, whether that's from rental income decreasing or their own revenue from job or work being diminished. Typically what we've done in the past is, and it's been a sustainable competitive advantage of ours, is that we don't charge our fee until the report is fully completed. So clients do not need to pay for our service upfront. You only pay when you're about to get the report. Our way of helping or trying to help or doing our bit to help in this pandemic environment is to offer a 50-50 payment option. The idea behind this, Terry, is that client would pay 50% of the fee to engage us. We will prepare that fully comprehensive ATO compliant report. We'll release that report so that the client can start benefiting immediately from those tax deductions, can pay less tax in this financial year. So benefits from minimising the tax expenditure, maximising the deductions, and then we charge the 50% balance for that fee in 6 months' time, when things are looking a lot more stable and people's situation has improved. So that's a pretty major change on our behalf in the way we operate to try and assist. And feedback tells us that it's been very helpful and very well received.
Okay. And you have outlined the typical cost to get a depreciation report, and you can use that for many years to come. But if something changes in your property, what's the process there, where if you may have done some renovations or put in some new plant and equipment, and to get the simple update, how does that process work?
Yeah, look, if there's a few items or a couple of items, that have been added to the property within 5 years of getting the depreciation report, it's likely we're not going to charge anything to update that report. If it's a huge renovation, you've gutted the property, spent $500,000 to redo it, there's likely to be an amendment fee to the report, but it wouldn't be anywhere near the full fee. You might be looking at as a guide, maybe $330 for a major expenditure like that. Might look like $110 including GST if it's a minor renovation. But as I said, that's only if these are being done, years and years and years after the initial report's done. Certainly any additions within the 5 years, a few items we'd likely include for free and update for free.
Okay. Well, we're approaching the hour. We always try to contain these live webinars within the hour. We do them in the middle of the day, mindful that people may be on a lunch break and need to be moving on. So it's probably a good time to be wrapping up. To close out, Peter, for people to make contact and to ask the questions they may have, or to actually action and get a depreciation report done, what should they do?
Sure. So feel free to contact me. You can address an email to me at info@washingtonbrown.com.au. You can also contact and speak to any of our fantastic sales team, our depreciation specialists. The number to call and speak to them on is 1300 990 612. But as I said, any of the team, myself, any of our fantastic team, be very, very happy to discuss your specific property with you, to look at whether you're eligible to claim, and if so, what those deductions might look like. and to provide you with a quote if it is worthwhile you proceeding. And that all of that process costs you nothing, absolutely nothing to ask the question, just to identify whether there are deductions and make sure you don't miss out and you don't leave deductions on the table.
Okay. All right. Well, thank you, Peter, for your presentation today and for the discussion about not only about tax depreciation, but some of the broader real estate issues. We do live in interesting times, but in times like these, as you pointed out during the presentation, it's probably now more than ever a situation that you should be doing everything you can to maximise your bottom line with your property investments, and tax depreciation is a great way to do that. A relatively small outlay in the beginning can return to you exponentially, and in terms of the tax deductions you can claim and the improvement to your bottom line. So thank you, Peter. Always informative, always great to have these chats. Let's do it again soon.
Yeah, absolutely. Thank you very much for your time today, Terry, and to everyone else for joining us, for donating your lunch break. Yeah, hope you'll keep well and stay safe.
Okay, so this is Terry Ryder from Hotspotting saying goodbye and thank you for participating, and thanks again to Peter Folds from Washington Brown for great information and an interesting discussion. Bye for now.